Welcome to Creating Wealth with Jason Hartman. During this program, Jason is going to tell you some really exciting things that you probably haven't thought of before and a new slant on investing. Fresh new approaches to America's best investment that will enable you to create more wealth and happiness than you ever thought possible. Jason is a genuine, self-made multimillionaire who not only talks the talk, but walks the walk. He's been a successful investor for 20 years and currently owns properties in 11 states and 17 cities. This program will help you follow in Jason's footsteps on the road to financial freedom. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Hey, welcome to the Creating Wealth Show. This is your host, Jason Hartman. This is episode number 338. Thank you so much for joining us today. And we're going to talk about a few things today. Our guest is an attorney who's licensed in 2 states who is going to talk about syndication and funds and how you can either set up your own syndication or your own fund, or you can, what you should know before investing in someone else's syndication or fund. And you know how I feel about this stuff. Commandment number 3, remember, thou shalt maintain control. So we will talk about that, and she just did a great job on this interview. It's very complete. And remember, folks, when you're talking to a securities attorney, most of them charge really high hourly rates. I do not know the rate of this expert. However, I would venture to guess she charges several $100s an hour, and she's very knowledgeable. So you get that all for free on the show. Isn't that fantastic? She's got a very good website, and you can check out a lot of information there. And if you need her services, she'll give out her website, so you can contact her as well. But before we do that, I've got Steve here with me, and I wanted to talk about a recent news item. This one's actually from Newser, and it is about something that may not surprise any of us, as the financial crisis occurred a couple of years ago, and we're still reeling from it, regardless of what Obama says, or the lamestream media. We've still got quite a few issues left. It seems like really no one has suffered any real consequences from that except Main Street America. Not the bigwigs, not the elites, not the people that ran the companies that basically pretty much ran the world into the ground financially, bankrupted countries, bankrupted huge institutions that are over 150 years old. Well, here is yet another example of zero consequences for their actions. And it's good old, you may have guessed it, Lehman Brothers. And this article talks about why Lehman Brothers wasn't prosecuted. And I have Steve here to talk to me about it. How you doing, Steve?
I'm doing great. I'm hoping that maybe the new leader of the free world, Vladimir Putin, can do something about this.
Yeah, it's interesting that you say that, because I think he has a lot more respect than our own president, Obama. Putin is looking really like the leader of the world.
It's pretty sad. He's just grabbing the bull by the horns, jumping up on the stage and telling everybody how it's going to be.
I'm not crazy about Putin, but in a lot of ways, it's hard to deny that you can understand why people have more respect for him than Obama lately. That's for sure.
Yeah, he's showing leadership. You don't have to agree with what he's doing, but he is leading here. And Obama just seems to be kind of going wherever his behind the curtain advisors whisper. But Putin's two steps ahead of him.
Yeah, well, Obama's a community organizer. What to expect?
He's not accustomed to dealing with chemical warfare and air attacks and things like that. But hey, he can bus a bunch of people to the polls. Did I say that?
Yeah, and let me yes, they do bus people to the polls. But if we attack Syria, I am just going to be so upset. I mean, this is just unbelievable, the way we just get in everybody else's business. And it's interesting how the world looks at chemical warfare, and only 1% of the deaths in Syria have been caused by this alleged chemical warfare attack, right? And, let's just assume it's true. But what about the other 99%? I mean, haven't over 100,000 people been killed already in this conflict? Where was the outrage then? I mean, it's just funny how our brains work. I guess being killed by a chemical is so much worse than having your brains blown out with a gun.
Yeah, because the person suffocated, Jason, it makes it a lot worse than getting ripped to shreds by bullets or a grenade. Don't you know this?
Yeah, or a landmine or whatever. It's unbelievable. It's don't get me started. Okay,
Yeah, we'll save that for another time.
Let's just look at the crooked elite scum that get off the hook in America, because I don't know. Sometimes I think America has left the building.
Right. We have a few things to talk about here, and just kind of elaborating on what you said, you've got the securities attorney coming on later, and they are the most highly paid type of attorney in my mind, because the law is so nebulous and so filled with potholes and favoritism and nepotism that these securities attorneys will always, they can never give you a for sure answer. They don't know what bureaucrat is working at the SEC that day. And it's really a shame, and it's on display here with the Lehman Brothers situation. Basically, what we have happening is the chief of the SEC, named Mary Shapiro, had a 8-member task force out of the New York office of the SEC tell her that they decided we're not going to file any charges, and the SEC only files civil charges, but they weren't going to file any civil charges. And she hit the roof. She was saying, well, why on earth are there no civil charges? This is clearly one of the biggest financial debacles that happened in 2008. And this chief in New York, his name's George Kanellos, basically said, we're not going to do it. She ordered him to keep investigating, said, no, there's got to be something here. We can't just not go after Lehman. And still, nothing. Crickets on this thing from this guy Kanellos, who I'm sure will have plenty to say about later in the show.
Well, congratulations to Dick Fold. He was running Lehman at the time, and he was known as the gorilla of Wall Street because he was so incredibly competitive. And looks like he's off the hook because Kanellos' team ruled out suing the firm because it was bankrupt. Well, isn't that always the case? The executives bankrupt the company and get away with all the money themselves in terms of their bonuses. And I mean, they talk about these clawback provisions. They never claw it back. I have yet to hear one story of a clawback. We'll see if it ever happens. But yeah, it's just, and so they decided they'd focus on individual investors instead. Well, why does the article say individual investors? I mean, what about the executives personally, their personal liability? It's unbelievable the way entities are used in the really big scale, elite, too big to fail game.
Yeah, it's pretty ridiculous because in a bankruptcy, those trustees are ruthless. We saw, I can't remember what the guy's name was, but he was the bankruptcy trustee for the Madoff case there in New York. And he was going after everybody. The owners of the New York Mets, the baseball team, they were big investors into Madoff, and he was going after them, suing them. I can't remember how many different lawsuits he filed to quote unquote go after these people that were investors. It seems that's a habit of the SEC, but the executives that actually did.
Let me just explain that for a moment, okay? So what that means, I'm not sure people really understand what you're talking about there. What that means is that in a Ponzi scheme, like Bernie Madoff or the U.S. Social Security system, either one, when the thing blows up, what they try and do is they try to go after investors who've taken money out of it and who've had profits and basically unwind the Ponzi scheme, which you can never completely do because whoever invented the Ponzi scheme has taken a lot of money out of it. And of course, they gave returns to the early investors so that they could develop momentum and other investors would come in and support them. I mean, that's the nature of a Ponzi scheme. And so they go and sue the early investors that took a lot of money out of the scheme to go and equalize the accounting and give some money back to the later investors who came in and got completely burnt. And it's always pennies on the dollar, if anything. But that's what they're saying here. It looks like.
That's right. That's what their idea was going to be. Meanwhile, these executives probably had pretty fat bank accounts.
Oh yeah. And I mean, Lehman. We're not saying Lehman was a Ponzi scheme per se. It's far more nuanced and complex than that. I mean, Lehman did all kinds of crazy stuff, but I think it's the same idea in the regulator's eyes. So
it is, and we can simplify it a little bit for the listeners, because what they were concerned about was something called Repo 105. And this is a practice where a Wall Street firm or investment bank, private equity group, whatever, would use these terrible securities. In this case, the bad pools and mortgages, CDOs, collateralized debt obligations. they would use these as collateral for loans. So they'd say, hey, look, I own all these securities, give me a loan. So I can go trade and do all their kinds of crazy derivatives, who knows what, right? So they'd use that as the collateral, but then they would list that transaction as a sale on their books. So it would show that I sold this bogus collateral, these bogus securities. And so it made their books look pretty misleading. And a bankruptcy court examiner basically said, this is really material misleading. And at a minimum of the Dick Fold said it was grossly negligent.
Which you know it's not negligent. You know Fold knew exactly what he was doing, I'm sure. I mean, he's an experienced guy.
Yeah, these guys have MBAs for their and PhDs for their accountants that are running the books.
They have incredibly smart people around them, and they're incredibly smart themselves, and they have vast amounts of experience. I mean, he's not some spring chicken, I just didn't know what I was doing. This guy's been on Wall Street for a long time. He knows the game. So to put that in like a real estate analogy, maybe, it would be like you buying as an investor a portfolio of houses. So say you have a portfolio of 50 houses, and say those 50 houses are worth $10 million. Well, it would be like getting a faulty appraisal on that portfolio saying that the portfolio was really worth $30 million when it was only worth $10 million in real life. And then going and borrowing against the portfolio, but telling your banker that you didn't borrow the money, that you sold the asset. So it looks better on your balance sheet, so it doesn't look like you have any debt, right? Mm-hmm. And the portfolio was overvalued in the first place. I mean, the value was smoke and mirrors. So it's just unbelievable the games these people can play at the highest levels of the financial system. It's like they get a pass. They just get to do all sorts of crazy stuff that us little guys don't get to do.
And it goes back into the complexity of the securities laws and all this. Nobody really knows what they mean. It's what's the mood of the bureaucrat or the prosecutor for that day, or who do you know? It's not a cut and dried thing.
That's the other thing. These companies that are being investigated by the SEC from time to time, a lot of these people that work for the SEC, frankly, their whole goal is to get offered a job by one of these companies. So it's such a conflict of interest. I mean, you go and investigate a company and you're hanging out at their beautiful corporate headquarters, and maybe, maybe some of the executives, while you're there doing your audit, they take you out for lunch. And they kind of hint that they might like to hire you. Hey, what were your plans for your life? So how long ago did you start with the SEC? You'd be really good on our audit team. Maybe we can give you a big fat bonus for signing with us, and somehow the investigation goes away.
So aggressively prosecuting Dick Fold doesn't bode well for your future job prospects unless you want to be a SEC government attorney. But if you work for Wall Street, you could make $2 million a year as the in-house counsel.
I mean, I'd say what you want about him, and I don't know the full story, but good old Elliot Spitzer, he went after these companies like really hard. He's not getting offered jobs by these companies. Okay.
How is Elliot Spitzer still even around? Shouldn't he have had to just ride off into the sunset?
No, hey, Anthony Weiner and Elliot Spitzer all came back, right?
Hey, New York, what are you thinking? You keep letting these guys back into the limelight. I'm going to get a bunch of New York hate mail.
The problem is, I mean, the reason the New Yorkers, that they have these crazy political races, it's because they're drinking sodas that are more than 16 ounces. that must be the problem.
Yeah. That sugar is rotting the brain or something.
Something like that, yeah. So what happens next year is the FBI decides that this move is technically legal, and they drop their criminal investigation, and then things go back to the SEC only on the civil side, right? Then what?
Well, basically, there's a bunch of finger pointing happening. Some people saying that, hey, Fold knew this was going on. He totally was the brainchild of this, or not the brainchild, but the author of this. And he, of course, denies it. And this Canelos guy just magically says, no, Fold was telling the truth. And the other executives were just ruled out for other reasons. So Canelos, the SEC investigator in New York, who the head of the SEC in Washington put in charge of this, just decided, nah, he's telling the truth. I'm a human lie detector. Dick Fold knew nothing about this.
It gets even better. Then the next thing that happens is Kanellis has this team of investigators, right? And they decide that the Repo 105 issue was not material. Okay, and we talked about that. It's not material information to investors, and hence it wasn't criminal to withhold information about it. It reminds me of the funds that register in Delaware so they can write off their fiduciary obligation by contract and say, hey, we're taking all of your money, but we don't have any fiduciary obligation to you as the investor. We can have conflicts of interest. We can act in our own interest. We have no obligation to you as the investor. There you go. Another example of that. Unbelievable.
By the way, that was great that you found that out. I'd always wondered why, but hey, that's what you get on the Creating Wealth show. Shameless plug.
Yeah. Listen, I'm going to pat myself on the back for that one because when I found out that this one fund that is trying to pitch our investors all the time registered in Delaware, now keep in mind, it doesn't have to be, and you're going to hear more about that on this show. And it's interesting how this very knowledgeable attorney kind of like, she doesn't want to really address that whole Delaware issue. You're going to hear that here coming up. Okay? But, and she says, it sounds like an ethical problem. Well, I agree. It's an ethical problem.
Of course it does.
But that's what people do. It's what we have nowadays, Steve, is we have a bunch of criminals basically running around in the business world. And you've always had these criminals. There have always been people that do bad things and take advantage, of course. But we have these criminals that don't look like criminals. They go to nice schools. They have upscale educations. They wear nice suits. And rather than using guns to commit their crimes, they use lawyers. They use accountants. They pervert the spirit of the law to basically take advantage of people. And so what you're going to hear is that these funds, when they structure, they'll have an investment manager will be a separate entity from the fund that holds the property or the business in which you're investing. And so maybe the business or the apartment building or the shopping center or the hotel or whatever the asset is, the underlying asset that they're asking investors to put their money into, that's registered in where it's located. Maybe it's registered in Arizona. Maybe it's registered in Texas or California or whatever, right? But then the investment management company, which is a whole nother company they set up. So now you have to figure out who's liable or can you sue them both or whatever, right? And when they bilk you out of your money or cheat you out of a higher return. Maybe they don't outright steal. Usually they don't. They just skim the profits off the top so the investors don't get as much. Well, that's registered in Delaware. And so they can contract away any fiduciary responsibility. Wow. Delaware is a very desirable state now that I found that out. Yeah.
I think there are more companies in Delaware than there are people.
Oh, I think there are. Actually, that's actually true. I believe. I've heard that before. Yeah. Delaware has a lot of post office boxes. Those are where companies are, quote, located, unquote.
That's correct.
Yeah. The registered agent business in Delaware is really big. Okay. So they threw out Repo 105, that concept, right? And then what do you have next? You have SEC's second highest ranking enforcement official.
Yes, they got to be in their bonnet about this too, and they recommended drafting potential charges against Lehman Brothers. So at least that way the attorneys at the SEC could review it and say, hey, this will stick, or we need to change this argument up or change that up. But this Kanellis guy, again, no, I'm not going to do it. Just not going to draft the charges.
Okay, so what Kanellis did instead, he drafted and proposed an SEC report that said why the SEC wasn't filing charges. And then Shapiro shot the idea down, arguing that the draft was too sympathetic to Lehman. Now, I wonder if there's, some crony capitalism going on here. You just have to wonder if, and you know what? Crony capitalism is so much more nuanced than an actual bribe, In a third world country, things are done by outright bribes. It's just kind of part of the business world from what I hear. But here, it's more like that example I gave you of maybe you should come work for my next venture.
Yeah, this bribery is a lot more complicated.
Well, what's your salary at the SEC? Oh, let me see. At the SEC, you make $150,000 a year, and you have government health care, you're probably exempted from Obamacare, like all the other higher government people.
Yep.
But we'll give you like a $2 million bonus for signing at my next venture. And we'll hire you there. We'll give you $400,000 a year. That's quite a bit better than your government job, huh?
Yeah, exactly. Exactly. A lot better. So I think the $2 million bonus, you could pay for your doctor visits, even under Obamacare.
Yeah, there you go. Okay, what happened next?
So basically, to round it off, Shapiro, the director of the SEC, ultimately just gave Kanellos what he wanted. Said, I'm going to give you what you want here because everybody else in the SEC is telling me that it's not appropriate for myself, a political appointee, to overrule Kanellos, a bureaucrat. So long live democracy.
Yeah, really. Long live crony capitalism. That's exactly what happened here. You know what's kind of funny? Once in a while, I'll think of like a childhood actress that I liked, for example, and there's those shows, Where Are They Now? Right?
Yeah.
And, sometimes I'll just look them up on Facebook, right? A lot of those profiles of celebrities on Facebook, I'm sure, are fake. and or you'll just look them up on the internet to see where are they now. So the question to ask here is, after Lehman Brothers, what happened to Dick Fuld? Well, we all probably remember the story of him getting punched out in the gym. Someone just came up and just whacked him in the face and knocked him out, apparently. Well, listen to this. You're going to love this, okay? So on November 10th of 2008, that date, shortly after, it's not after, it's as the financial crisis was unfolding, right? Fuld transferred his Florida mansion to his wife, Kathleen, for $100.
Ooh, that's a good price per square foot.
That's the whole house.
Yeah, that's what I mean.
Yeah, that's an incredible price per square foot. So, hey, Kathleen, my wife, do you have a Benjamin in your wallet? Pass me over that Benjamin in your purse, that $100, and I'll transfer the mansion to you in order to protect the house from potential legal actions against me. Okay, this is Dick Fuld talking, of course.
Yeah.
And they had purchased the house 4 years earlier, Steve. Forget this. $13.75 million. And Kathleen got it for $100. Boy, she really, his wife really knows how to take advantage of a desperate seller, doesn't she?
Yeah. She knows how to find the don't want her, so to speak.
Yeah, the don't want her seller. If you can pull that one off in the open market, that $100 deal, they say there's a few really good ways to get rich. Either marry it or inherit it. Well, there you go. Okay.
You go.
Now, this is from Wikipedia, by the way. Okay. So in late March of 2009, Dick Fuld had an email sent out stating that he joined Matrix Advisors, a New York-based hedge fund. They probably offered him a couple $1 million just to sign, right? Not that he needed the money.
A couple million.
Yeah, probably more than that. Who knows? And then in May of 2010, Fuld was registered by the Financial Industry Regulatory Authority, otherwise known as FINRA, as employed by Legend Securities, a securities brokerage and investment banking firm in New York. And then Fuld left the firm in early 2012. So I don't know why the guy can't just enjoy his retirement. I mean, with all the money he's got. But I wonder if he took another job after that.
I don't know. In the normal legal environment, when there's a lawsuit, when there's a complaint that arises, you can't get away with that nonsense of transferring deeds and stuff after it's known that there is a legal dispute. It's called a fraudulent transfer.
Well, this guy, this doesn't apply to the elite class.
Well, I was just going to say that in order for that to be a problem, you'd have to have a lawsuit filed in the first place, which, thanks to his buddy Kanellos, is not happening. I really would like to follow this in the future, see where this Kanellos guy ends up.
Yeah, he's going to end up working with Dick Fuld in the future, I bet, somewhere at some company, right?
Oh, yeah. He just talk about turning a blind eye. Lehman went bankrupt?
Unbelievable. It's just sickening. It really is. Okay, well, Steve, let's talk about something more cheerful here before we get to our guest. Tell us about Little Rock, Arkansas, good old Slick Willie Clinton's hometown. And since we opened that market just recently, you've had some clients buying there, right?
We're having a great time in Arkansas. I don't know. Was that good?
That was a pretty good Slick Willie Bill Clinton.
Yeah, okay.
Example, yeah. And I got to tell you, looking back, I'm beginning to really like Clinton.
Yeah. Wow. Talk about your free market capitalist, huh?
This is called contrast.
That's exactly
compared to Obama. Clinton looks like a star. He looks like Reagan to me now.
He is amazing.
Yeah.
Oh, yeah. Please come back. Well, we might get his wife, but that's for another day. So we have a great property in Little Rock, Arkansas, and I'm looking at the pro forma, which is, of course, a projection of how our team thinks this property is going to perform. And great little property that is 1,200 square feet. It's an $89,000 property.
So you're way below $100 a square foot, but not nearly as good as the deal Kathleen Fold got from Dick Fold.
Yeah, I'm sorry. If you're looking for that deal, what can I tell you? Rates have gone up. It's not going to happen. So I wonder what her mortgage payment is.
Well, let me see. It's $100, so she probably just bought it free and clear.
What is Kathleen Fold's cash-on-cash return?
Well, I think they're living in it, so it's technically still a liability, as Robert Kiyosaki would say. But
move out, rent that thing.
Pretty good deal overall. Yeah.
Yeah, Kathleen, what are you doing? So the total cash invested for this property, this includes your closing costs, your origination fees, and all that, is about $26,000, and the property is rented for $975 a month. So it's well above a 1% rent to value ratio, which we like. And your cash on cash return on this property is 12%.
Nice. That's really nice. And your overall return on investment is projected at 36%. So the famous Jason Hartman quote, if it only goes half as well, you're still making 18% on your money.
Exactly right. Good, solid property. It's a little bit newer. I believe it was constructed in the early 80s. I'd have to verify that. But with a $975 rent, it's going to be a pretty solid area. Those properties that rent for around $1,000 are usually in the better areas.
Fantastic. Okay, good. Do you have one more?
I do, because we're going to be down in Austin. In fact, we need to think of somewhere good to eat.
There's lots of great places to eat in Austin. I love that city. That's a great town.
Yeah, I get in at like 6:30, so I'll call you and we'll go eat somewhere good.
Yeah, I think I landed 4 that day on Friday. So yeah, we'll go have some good Texas food in downtown area.
Looking forward to it. So we've got one in Hutto, Texas. This is in the Austin metro area.
That's a suburb?
Hutto.
Sure.
Yep. And
we've done a lot of business there over the years, by the way.
Oh, it's great. Yeah. It's great. And these things rent out like crazy. The Austin economy is booming. It is absolutely booming. Apple has moved a large operation there, and so many different tech companies going to Austin. And then you've got the educational and the governmental presence all there, servicing that huge state. So many of those kinds of jobs in the Austin area. And this property is a little bit bigger, built in 2003, and it's 2,200 square feet.
What's the price?
And the price after you do your rehab, because this thing's going to take about $7,500 in rehab. The price will be $48,000 cash in. Your total price will be just over $140, depending if that rehab stays exactly at $7,500. So what I really love about this one, Jason, is the cost per square foot is $61 in Austin. That's the cost of construction.
Awesome.
Yeah, the cost of construction has to be in the high 80s per square foot, and that doesn't even include the land, which is more expensive because the environmentalists like Austin. Therefore, they have jacked the real estate price. They have a tendency to do that with all their environmentalism.
Right.
So
yeah. Okay.
your cash on cash a little bit lower, but it's a newer house that you sit on for that growth and get some cash flow in the meantime. Is 5%. That's a projection. And your total return is 25%. And this thing will rent like wildfire.
Yeah. That's an easy market to rent in. And I got to tell you, those Texas rents, the higher property taxes in Texas are definitely pretty well offset by the higher rents that you get, because tenants, this is what people that just don't understand economics just don't understand. And it is the concept of pass-through. Whenever there's an election going on, you hear the left always talking about corporate welfare and how the corporations are getting away with murder. And, I don't disagree with them, actually. I think they are, because we live in this sort of socio-fascist crony capitalist, but it's only crony capitalism for the elite, the big capitalist, the too big to fail type capitalist type environment. And they talk about corporate welfare and how the corporation should pay more, right? But what they don't realize is as soon as you make the corporations pay more, all they do is raise their prices. They just pass it right through. Same with properties. If you as an owner have to pay a higher tax rate on your property taxes, it just passes through to the tenant, but usually the tenant doesn't know enough to figure that out. Because if they live in Texas, they think, hey, I'm getting away with murder. I don't pay any income tax because there's no state income tax in Texas, which is beautiful. And I don't pay any property tax because I'm a renter. But if you take that same house in a sort of a comparable city, like, you compare maybe Austin to Atlanta. I mean, of course, every city has so many differences. You can't really compare them. But say it was like a similar house, similar neighborhood, everything else being equal, you'd see that the rents are higher in the Austin house because the property taxes pass through to the tenant. So it's a pass-through entity. Things always pass through. And one more thing I want to ask you about those, Steve. By the way, two great properties. Thanks for telling us about those.
Sure.
One more thing I want to ask you about, though, is Las Vegas. Years ago, I did some business in Las Vegas, and we really just haven't been that interested in that market. A lot of our listeners have asked us about it, and share some of your thoughts on it.
I was actually there over the weekend with my wife, so it wasn't a business trip. We went down and saw Jerry Seinfeld, and he's still got it.
He's still funny, huh? Yeah. Good.
Oh yeah. He's adapted and moved with the times, and yeah, I haven't laughed that hard in a long time. But you
don't strike me as much of a Vegas guy. I doubt that you gamble, and I know that you don't drink.
We go down there for, a couple of the shows and the food and just the lazy time. The reason being, and I'll just tell on the show, we're going to have our third kid here in late December.
Yay! You told everybody.
I told everybody, yeah. And so we just thought, okay, we got to get out of here while we still can.
Right.
Exactly. Because it's going to get complicated.
Yeah, well, good stuff.
So, and it's close. It's a quick drive. So we went down, had a great time, but I always watch that market because I've done a few flips there over the years because it's close to me and I have a lot of contacts there. And actually talked to a couple of contacts last week, and they told me exactly what I expected to hear, that the prices have gone up. It's cooled slightly, but they've gone up crazy, about 35% in the last year alone. This is according to an article from Inman News. And what this has done, because the financing has still been so difficult to obtain, is these are almost all investors, and it's made the rental market a little soft. There's a lot of properties for rent. It's going to take more time to rent these out, and you're going to get a lower price. And so what's happened is people are having to pay a lot more for a lot less rent. And we just can't get close to that 1% rent to value ratio. You're going to have to pay $140,000, $150,000 in many cases to get $1,000 in rent. And even then it's going to take you 60 days in some cases to get that amount of rent. So hey, Vegas has got bright lights, a lot of fun things to do, but you'd be better off investing your money in Little Rock or Indy or Atlanta. And then you can go have fun in Vegas. Just don't invest there right now.
That's sort of one of my somewhat famous quotes is invest in places that make sense so you can afford to live in places that don't make sense. And
that's right.
That kind of applies to this concept. Maybe it's invest in places that make sense so you can afford to vacation in places that don't make sense.
That's right.
And so that's kind of applicable to this whole concept. I mean, the market's, it's just not that great. If you like Vegas, I mean, I'm not much of a Vegas person, but I always seem to end up there because I've always got a business convention or something there twice a year maybe. But go vacation there if you need to get that out of your system. It doesn't mean you should buy a property.
That's what you do there, because the irony is it's a gambler's market. It's so volatile. And I've talked about that on the show before, but I remember I went down to Vegas. It was in 2009, and I was looking at some high-rise condo units. And there are a couple of towers. Some of you probably know what they are, the Turnberry Towers up there.
I looked at those, yeah.
Yeah, a little bit east of the Strip, kind of up on the north side of it. And these towers, they have these, what is it? Is it concave or convex, where the windows kind of curve outward? So that's where you'd have these convex windows that would show kind of the lobby of each floor, and you could see 3 or 4 doors going into the separate units. So I was in actually the top of one of these Turnberry Towers looking down at one of the other towers, and I could see the front doors of all of these units for, I believe, about 40 floors going down. And I could see that little 8.5 by 11 notice a trustee sale on about half of them. You could see that paper on the door. I mean, these units, they sold for $1 million easy at the top of the market back in 06 and in 07. And you could buy them for $200,000, $300,000 back in 2009. But you were crazy if you did that, so to speak. And so, hey, if you did that, you put it all on black, you're in Vegas, baby. You made money. but just as many people got burnt and got hurt because it's just such a roller coaster of a market.
Yeah. Anything that's exciting and sexy is probably not the place to invest. That's the rule. Get yourself a nice little boring place like Little Rock, Arkansas. Sorry, Little Rock friends, no offense intended, but you're not making the news every day like Las Vegas, okay? And that's why we like you so much as a place to invest. So and all the other similar type cities. So good stuff. Yep. Well, hey Steve, we got to get to our guest because we have a fairly lengthy discussion with her, and she's darn interesting. So let's talk about syndications and crowdfunding and some of this stuff. It's pretty fascinating. So let's go to her, and be sure to join us for our Austin property tour coming up. We're about a little less than 3 weeks away from that, and it's going to be a great time. So register at jasonhartman.com. And Steve, thanks for joining me today.
My pleasure. Thanks for having me.
We'll be back and talk about securities and crowdfunding here in just a second. Be sure to call into the Creating Wealth Show and get your real estate, investing, and economics questions answered by me personally. We'd love to have you call in, share your experiences, ask your questions, and a lot of other people listening have those very same questions. So be a participant in the show at 480-788-7823. That's 480-788-7823, or anywhere in the world via Skype. Jason Hartman, ROI. That's Jason Hartman, ROI, for return on investment. Be sure to call into the show, and we are going to enter all of the callers in a drawing for some nice prizes as well. So be sure to call into the show, and I look forward to talking with you soon. It's my pleasure to welcome Kim Lisa Taylor to the show. She is a California and Florida licensed attorney and partner in the real estate securities law firm Trowbridge and Taylor LLP. And she has done over 100 private placement offerings. And I think you're going to learn some very interesting stuff today about syndications, securities, the Jobs Act, that is going to have a very significant change, I think, on this market, and some of the stuff investors should look out for as well. So, Kim, welcome. How are you?
I'm wonderful. Thanks, Jason.
Well, good. It's great to have you on the show, and you're coming to us today from somewhere in Florida, I believe, right?
That's right, St. Augustine, Florida.
Fantastic. Well, welcome. So, first of all, maybe a good place to start is helping listeners get an understanding of what is a security.
Well, there's two ways that this comes into play, particularly for real estate investors. Both the state and federal laws define what constitutes a security. And if you look in any of those definitions, you would see probably the first thing listed is always a note, and they're talking about promissory notes. The second thing is further down in the list. Usually you'll see something called an investment contract, and that is the one, if you're not dealing in notes and promissory notes and borrowing money in order to fund real estate transactions, then the other thing you might be doing is finding passive investors and bringing them into an investment company, like a limited liability company or something like that. And so there's a kind of a little four-pronged test we use to determine whether or not something constitutes an investment contract. And it's these four things. It's an investment of money in a common enterprise with an expectation of profits based solely on the efforts of the promoter. And the promoter would be the investor or the person who has the real estate opportunity and is looking for the money. So, if you're bringing in passive investors, you're probably dealing in investment contracts. Those are securities. So if you create a security, then you have to follow securities laws before you can start asking investors for money.
So does a security mean that it's fractionalized, that you're only doing part of the deal? Would that be a way to know? Is that like a sniff test for a security? Is it part of the deal or all of the deal type thing?
Not so much. That's certainly a good indicator that it could be a security, but the real test is whether or not the investors are passive or if they're actively involved in management. Because you could have a situation where you've got 3 or 4 members of a limited liability company, but everybody's going to be involved. Everyone has a role. Everyone has a job, more than just a voting interest. And maybe part of those people put up the money and part of those people are actually doing the physical labor of finding the deals and making the rehabs or whatever happen. So in that situation, if everyone is staying actively involved in managing their own money then you haven't created a security. And that's another typical name for that would be a joint venture or a general partnership. But when you get into other types of structures, such as a manager-managed limited liability company, where the manager is calling all the shots and making all the decisions, or a limited partnership, where you have one general partner that's in charge of everything, and the limited partners just have a passive role and putting in the money, then either of those situations are pretty classic definitions of securities. So, and it really wouldn't matter if you had one person or if you had 25. It's still a security.
Right. Okay. So there needs to be a manager to make it a security, right? Then, because if there's not a manager, the investment can't be passive for the investor.
Sure. That's a good way to say it.
Yeah. Okay. Okay. So if there's someone managing the deal, even if you're the only investor in the deal, it could be considered a security, right?
That's right.
Yeah. Okay. All right. So now the manager, do they need to have an equity stake or not? Probably not, right?
They don't have to. Sometimes they do. Sometimes they retain a percentage of ownership of a company, or they would also perhaps earn some fees. So there's different ways that they can earn money, but they don't necessarily have to invest their own cash.
Right. But they could take equity just for their labor or for setting up the deal, right?
Sure, they could.
Yeah. Okay. But they're not required to. That doesn't make it
No.
a security either way or weigh on it.
No.
Yeah. Okay. So what happened in the world of, on past shows, we've talked about the world of TIC, tenant in common deals, which were all the rage a few years ago. I mean, I remember people hitting me up trying to get access to my investors always to present their TIC or tenant in common opportunity. And my understanding is a lot of companies and people got into trouble in those because they were trying to market them as though they were a real estate deal. And I don't know the final ruling, if there ever was one actually, whether it was a security and then it would have to either be registered or comply with other requirements, or if it was a real estate deal, just a fractionalized real estate deal. That's what they were trying to say.
Yeah, you're right. That was kind of the way things were operated. A lot of real estate brokers saw opportunities where they couldn't sell a big property, say, to one investor. Hey, why don't we combine several investors? And if they all buy fractional interest in the deed to the actual real estate, then we're not selling securities. We're really just selling real estate. The problem is that a lot of those deals were sold as real estate deals coupled with a management contract offered by the broker. And so it was that coupling with this management contract, I think, that really kind of crossed the line into the world of securities because, again, who was promoting the deal? It was the broker. And who were the investors relying on to generate that profit? Again, it was the broker because they said, hey, I'm just investing, I'm buying something, but I don't really have to do anything with it. The broker's going to handle everything. So that's how they kind of fell into the realm of securities laws. And yes, there was a white letter ruling by the SEC that this said that this kind of a scenario really isn't just the sale of real estate. These people are relying on you to make a profit, broker. This is truly a security. And if you're going to do these kinds of deals, then you either need to register these as securities offerings by getting pre-approval before you offer them, or you need to qualify for an exemption from securities laws and operate the company in that way. And the biggest stumbling block to anybody wanting to do that was that most of the private offering exemptions that would have applied to what they were doing did not allow them to advertise those deals.
So they were advertising. I mean, I remember seeing the advertising. What happened to these people?
A lot of them just kind of, ended up dissolving, and, it really just, I'm sure there's a lot of them still in existence, but they just, were not able to continue to offer their properties for sale in that way. So now what they need to do is actually just go ahead and comply with the laws like all of the other real estate investors out there have been doing all along. And that is just, acquire the property and in the name usually of some kind of a company, and then offer investment opportunities to people with whom they already have pre-existing relationships.
So what is the allowable technique then? If someone is syndicating a deal, say they find an apartment building, and one of the things you said is apartment buildings are like the most common syndication, right?
Yes.
Okay, so say they have an apartment building that they want to buy and they want to go raise money for it. Are they allowed to advertise?
Well, up until the end of this month, they have not traditionally been allowed to advertise. There are a number of different exemptions to securities laws that could be applicable to an offering like this. We call these types of offerings where you're forming a company and bringing in investors. We call them real estate syndicates or syndications. And these kinds of syndicated deals can be offered either under federal exemptions to securities registration or state exemptions if everything is all within one state, the promoter of the deal, all of the investors and the property. If that's all in one state, then there could be a state exemption that would apply to allow perhaps some advertising to be done to find investors. But traditionally, if you're not getting pre-approval from either a state or federal regulatory agency before you actually offer the investment opportunity to investors, you usually cannot do any kind of advertising or solicitation, because that's kind of the difference between a public offering, one that's been pre-approved by a regulatory agency, and a private offering, which is what these exemptions are aimed at. They're saying, the regulators have said, if you are only going to offer this to people that you already know and you're not going to advertise it to the general public, then we're going to stay out of the way and we're going to let you do that. But there are a few rules that you'll have to follow. And so whatever exemption you choose will have its own different set of rules.
So what are these exemptions called? Are they like the 506 exemption?
Yeah, under the federal law, there's several. The one that is by far the most popular and most often used is called Rule 506, Regulation D, Rule 506. There's also some others you may have heard of called Rule 504 and Rule 505. Those have some limitations that don't make them quite as popular. They have some dollar limitations. But under Rule 506, a syndicator can raise an unlimited amount of money from an unlimited number of accredited investors and up to 35 sophisticated investors, as long as they don't do it through any means of general advertising and solicitation. The investors can be from any state, even foreign investors could be included. And the only thing that it preempts, this Rule 506, this federal Rule 506, preempts state laws, so that the only thing that can be required by the states is a notice from the syndicator that they have sold securities to someone from that state, and giving the state jurisdiction over them in the event that the state determines they did not follow the Rule 506.
Okay, so what are those dollar limits you mentioned?
For the Rule 504, it's $1 million in a 12-month period. For Rule 505, it's $5 million in a 12-month period, and you'd have to have a 6-month gap before you could do another offering.
Okay, so that's the amount that the syndicator can raise.
Under the Rule 504 or the Rule 505. Under Rule 506, it was an unlimited dollar amount.
Okay. And is there any maximum amount the investor can put in?
Not on either of those particular, the Rule 504, 505, 506. There are some other exemptions and some proposed exemptions that would have some dollar limits on things the investors could put in.
And does it matter if it's what if it's a business, say a startup business, the next Facebook? Does it make any difference if it's a business versus, say, an apartment building or a real estate deal?
Not at all. You can raise money under these securities exemptions for small businesses, for any purpose, really. It's just, a common enterprise.
Right. And what requirements does the investor have to meet? Like, describe the different types of investors. There's a sophisticated and accredited. There's neither. Is there another category?
Well, I think those are probably the most common ones. The accredited investor is someone who has over $1 million net worth, exclusive of any equity in their primary residence, or they have income, if they're an individual, of over $200,000 a year, or if they're a married couple that files joint income taxes, the level has to be over $300,000. So it's $1 million net worth, $200,000 if an individual, $300,000 if they're a couple.
And that's an or, though. That's
yeah,
or.
That is an or. It's
okay,
net
so
worth
so in
or
other words,
income.
they could have a net worth of $100,000, but as long as they make over $200,000 a year as a single person, or $300,000 married filing jointly, then they can do it, right? They're considered accredited.
Yes, that's right.
Okay.
That's right.
Now, do they have to have done that for any length of time, or could they just have suddenly had a good year and and they're making 200,000-300,000 if they're married, and they can be accredited?
It has to be for the last 2 years with an expectation that that would continue within the next year, at least as far as the income requirement.
Right.
I don't believe there's a time limit on the net worth requirement.
Right, okay. And what about the sophisticated investor? That's a different category.
It is. So that's someone who's not accredited, who, by reason of their educational, business, or financial experience, either by themselves or with assistance of their investment advisor, has the ability to evaluate the risks and merits of the offering.
So how do you quantify that? That one seems like a Pandora's box there.
Yeah, it's very subjective. I like to suggest that the investor should explain that in their own words. And so we use something called a pre-qualification questionnaire that we offer to our clients. And they can submit that to the investor, and the investor can say in their own words what they believe makes them sophisticated enough to be in the deal, and they can explain their business, financial, or educational experience that they feel qualifies.
Now, we're kind of talking here from the perspective of the syndicator. Like if someone listening wants to go out and buy a big property or start a business and raise money for it, we're kind of taking it from that angle. But why is it important, Kim, as an investor, that you know that the person syndicating the deal or being the general partner on the deal. Now, by the way, that term general partner and limited partner, those terms, do they have anything to do with this?
Sure. Usually, the terms are kind of used in
kind of
common
generically,
usage.
right?
Yeah, generically. They definitely have specific legal meanings, but within the context of this discussion, when you're speaking about a general partner, you're usually talking about, someone who's managing the deal, someone who's in charge, someone who's, gone out and found the opportunity and is making it available to investors. And then the limited partner or the member of the LLC or the investor, those are kind of synonymous terms. And then that's the person that's usually putting up the money in a passive investment scenario.
So why is it important, though, my prior question there, why is it important that the investor understand this stuff? Because before we started recording, we talked about how you want to make sure that your syndicator is obeying the laws, because if they're not, that could jeopardize your investment, right?
That's exactly right. Yeah, it's very helpful for the investor to understand how these deals are structured and what the legal requirements are for these exemptions, so that you can kind of determine whether or not the person that's asked you to invest is following the law. Because someone who is not following the law, we say there's two kinds of people that don't follow securities laws, and it's those that don't know or those that don't care. And in either scenario, your money could be at risk if you're investing with one of those people. So if you understand the law and what's required, then you can make sure that the people that you're investing with are following the law. And I think that it's probably a less risky investment.
But there's really no way the investor can know if their syndicator or general partner or whoever's trying to raise money for this fund is following the law. I mean, maybe they didn't, say, for example, break the advertising rule with you, but they did it with the next 10 investors that they got, right?
Well, and that's true. You don't know as far as how they're advertising unless you received the ad for the investment and you're responding to an illegal advertisement. So we've written an article called The 10 Things That Investors Should Know Before Investing in a Real Estate Syndication. It just kind of outlines the types of things that the investor could ask. And if the syndicator is forthcoming with that kind of information and has that information, there's a pretty good bet that they understand the securities rules and they're following them.
Okay, now, when someone wants to set up a syndication, they need to form an entity. Actually, in your case, you suggest they form, 2 entities, right?
We do. We usually suggest that the manager of the deal is its own entity, generally because there's more than one person usually involved in a syndication. It's a lot of work, and so there's a lot of hats to be worn. It's usually more successful if there's multiple people involved in the management of a syndicate. And then we would form also the investment LLC, and that's the manager-managed limited liability company that will usually take title to a property and then sell interest to investors.
Is there any particular state? Is one state more desirable than another to form these entities?
It depends on what you're doing. If you're doing what we call a specified offering, where you have a specific property under contract and you're trying to raise money for the down payment and the closing costs for that specific property, generally you would want to form at least the investment entity in the state where the property is located.
Okay, so say, for example, it's in Arizona, then you just form that entity right in Arizona, right?
That's right, because Arizona is going to want you to, even if you formed it out of state, they would want you to register that there in order to legally operate in the state.
Okay, so you form, an LLC in Arizona?
Typically, we'll form an LLC. That's the most common structure for these kinds of syndicates.
Now, that's the entity that actually holds the property, right?
Yes.
But
yes.
then there's the manager of the deal, and that's a separate entity, right?
That's right.
Okay, and where should that be formed?
Well, and again, that's going to depend on where are the people that are going to be involved in that management entity. And if they're all in Arizona, then we would suggest that should probably also be an Arizona LLC. But if they're in multiple states, you might look at forming that in Delaware or some other state.
Why Delaware? I think I know the answer, but I want to ask you.
Sure. A lot of people like Delaware. Delaware has a really well-developed body of law that is favorable to companies. And it also has a court of chancery that handles business disputes outside of its normal court system. So things don't tend to get bogged down as much as they would.
Yeah,
in
what
other
is this chancery court? I've read about that. What does that mean, chancery?
I'm not really sure.
Probably British.
Yeah, probably goes back to some English common law. But it's really just a separate court system that's designed specifically to handle business issues.
And there are no juries in the Chancery Court, so typically they say that Delaware is very favorable to businesses, right? And
that's what I've heard.
Yeah, and not to investors, if the investors should be suing the syndicator, right?
Well, I wouldn't know. We don't do litigation, so I wouldn't probably be the person to ask that.
Yeah, okay, fair enough. That's really interesting. Now, one of the things that I heard about Delaware, and I was talking to a tax attorney about this a couple of weeks ago, because there's this group in Arizona that's forming these funds and trying to raise money, and they said that they formed their entity in Delaware. Now, I don't know which entity that is, because you made a further distinction for me about the multiple entities, but I guess a lot of these hedge funds really like Delaware because you can write in the contract, in the offering agreement, that you have no fiduciary obligation to the investors, and basically just contract away that responsibility. And I guess that's the only state where you can do that. That's pretty attractive for the person setting up the fund or setting up the syndication, right?
Yeah, I think that goes to some further ethical issues that are probably beyond the scope of this discussion.
I agree with you. That's one of the reasons I picked at this offering and didn't like it, because as an investor, I want them to have a fiduciary obligation to me, right?
Right.
Yeah. Interesting. Well, now it's a pretty exciting time in your business, Kim, because today is the ominous September 11th that we happen to be recording this, but in just about less than 2 weeks, there's going to be a big change, right?
That's right. Under the previous Rule 506, you could not advertise. There was no advertising or general solicitation was simply not allowed. And that meant that you couldn't do print ads, you can't stand up at a RIA and advertise your offering. So there were all these restrictions on how you could advertise and to whom you could invite into your offering. In fact, it went one step further, that you actually have to establish that you have a pre-existing relationship with somebody before you could even tell them about your deal. And the pre-existing relationship is not just having known someone for a period of time, it's actually knowing their financial situation and understanding their investment goals and whether they were suitable to invest in the kind of thing that you had to offer. So, and then, you had to have the pre-existing relationship starts when you find out their financial information, then you have the suitability conversation with them, and then you had to further allow for some passage of time before you could invite them into a current offering that you had. So there were all these nuances and restrictions, and it was very subtle, some of the distinctions between what was legal and what was not legal, and it was a great source of confusion for a lot of people. Now that rule is still in effect, but the SEC approved via the Jobs Act some regulations back in July that now take effect on September 23rd that will allow advertising for deals that are only being sold to accredited investors. So they've added a couple of stipulations onto it saying you can now advertise, and the really great thing is you can advertise to anybody, but you have to restrict the people that actually invest in your offering to accredited investors. Under the old rules, and so now we've got this new rule. It's called Rule 506 subsection C. Well, so the old rule used to just be called 506. We're now going to call that 506 subsection B to distinguish the two. So under the old rule 506B, the investors were really just allowed to fill out that pre-qualification questionnaire that I mentioned earlier, and they would just check a box saying, yep, I'm accredited, I meet one of these standards for net worth or income, or I'm sophisticated, and here's why I'm sophisticated. Now, under the new Rule 506C, the burden has been shifted to the syndicator to determine whether or not that investor is truly accredited. And so they're going to actually have to do some underwriting, the same as if someone was applying for a loan, where they're going to have to look at their net worth, their financial statement, or they're going to have to look at their W-2 forms or their tax returns and their credit reports to determine if they meet the income requirements. If the investor doesn't want to give that information to a syndicator, then they have the option of going to their own CPA or licensed attorney or registered financial advisor to get them to write a letter saying that they've reviewed those documents for that investor within the last 90 days and that they certify that that person meets the standard for accredited, and then they can invest in the offering.
Okay, but overall, I mean, syndicators have to be loving this, right, Kim? Because, wow, now you can advertise to the whole world. The limit before used to be that you had to have that prior relationship, and there's some nuances to that, definitely, from what it sounds like. But now they can just put an ad in a magazine, they can go on TV, they can go speak about it at public events, etc. But they do have a little more burden on the back end to verify that they're really accredited investors that they're dealing with, right? Or sophisticated.
And that is true. But one of the limitations that we see is that our clients tell us that they are raising most of their money from sophisticated investors. So
not accredited.
Not accredited. So if you want to bring sophisticated investors into your deal, and say, for instance, people with self-directed individual retirement accounts, a lot of them would meet the definition of sophisticated but not accredited. If you want to bring them into your deal, then you really have to go back and still do the old Rule 506B and follow those rules with getting to know them and before you make them an offer.
Mm-hmm. Wow. Yeah, interesting. But I mean, generally speaking, though, was my prior statement right that the people, like your clients, have got to be loving the Jobs Act, right? I mean, they're just chomping at the bit, waiting for September 23rd, I bet. I mean, no?
That we are definitely seeing that. We've seen an uptick in the number of calls that we're getting. We hold workshops, and, where last year we were getting, 20 or 30 people into our workshops, now we're getting, standing room only and waiting lists. And so, we're definitely seeing some additional interest in this. And I think it's going to be a big deal for the capital markets, and it's going to allow a lot of investors who have been kind of stuck in the stock market to start to learn about these offerings. They may not have even been aware that there were options and alternatives to the stock market, and now they're going to start seeing these ads, and they're going to kind of wake up to that, and maybe it'll open up some doors for them as well.
Right. Yeah, that's a good point. The Wall Street people have to be hating this probably because they're just, it's all about money. Money is their business, and if money is diverted into other opportunities, that's bad for them, right?
Well, it is, but the SEC did some pretty deep analysis on all of the, how is this going to affect the markets when they started passing these rules. And one of the things they found is that there is almost as much money being raised through private offerings as there are through the public markets.
But this will just expose that private market to a much larger audience.
Sure.
Yeah.
Sure.
Wow. That's a real boon. It's a big change. Yeah, very interesting. One of my last questions I just wanted to wrap up with, and I so appreciate your time. This has been very educational. The listeners will love this. I usually object to investing in deals that someone else is running, these pooled money type of deals, because you just don't have any control over the way they're spending the money, the way they're managing the deal. Ostensibly, the idea here is that you're taking and investing and you're buying their experience. You've got someone who's far more experienced than you, hopefully, managing and setting up this deal, and you can benefit from their experience and their connections and their resources. But on the other side of it, you just don't know, what are they paying themselves? What are they doing with the expenses? Are they spending money on first-class airfare and wining and dining other investors to raise other money for the fund? How do you have any control over that?
Well, a lot of these offerings are composed of a pretty small group of investors, and at least in our segment, in our sector of the market, we've been helping investors that are usually raising somewhere less than $5 million. $1 to $3 million is very typical. I think that with the new advertising rules, we'll start to see some bigger funds, people probably wanting to expand and raise $10, $20 million. I think that the bigger the fund, the less control over that kind of a thing you have. The smaller the fund, though, you could have a very small group of investors, maybe only 4 or 5, less than 10 investors that are meeting quarterly on teleconferences, discussing how the property is going, or how if it's a blind pool fund to buy, say, single family fix and flips or buy and holds, there could be quarterly teleconferences to discuss what's in the portfolio and what the stages of those properties are in. So I think that this group of investors can get pretty intimate, and depending on who the syndicator is, they can have a pretty close relationship with them. Even though they may not be able to vote on every decision, they can certainly look for syndicators that are going to keep them informed and will have maybe an opportunity to voice their opinion on what they'd like to see happen, and that manager would be willing to take that kind of thing into effect. So,
I agree with you, and that's all just good business, everything you mentioned, of course. But when it comes to who's writing the checks, who's using the credit card, who's paying the bills for this entity, the investor just doesn't really see that. They don't really have control over that stuff. That there's so much complexity involved. It's a whole other business. And in this case, it's 2 other businesses, because they've got their management company and then they've got their entity that actually holds the property.
Right. Well, there's ways that these deals can be structured to put some checks and balances in place for that. And, certainly the first thing that the investor should be doing is reading the private placement memorandum, because that's going to tell them how the deal is structured. It's going to explain what kind of fees and distributions that the manager should be entitled to, and what the investor themselves is going to be getting, and when they should be getting that. And so, the first way to arm themselves is to understand the documents and to ask a lot of questions and to stay informed about what's going on with the deal.
I remember this one company I invested a couple apartment deals with back in, several years ago, and they presented beautifully written, like, business plans or offering memorandums, and they were just very well done. But when I started to look at it, Kim, and I still did the deal, but I started to look at, like, all the ways they're making money. They'll have an acquisition fee when they buy the apartment. They'll have a disposition fee when they sell it. That goes right to them, not the investors, right? They just take that money off the top. And then
Sure.
they'll get their own return, and they might even offer the investors a preferred return. But if the deal goes bad, maybe they can't even pay the preferred return. But the preferred return isn't what we're all investing for anyway. We want a nice big upside. And I don't know, it seems like the position you want to be in is at the top of the food chain. You want to be a syndicator. Like, I want to be your client more than I want to be.
Unless the deal doesn't go well, and then you don't want to be that person either.
Yeah.
Because,
what happens in that case? I mean, it's all someone else's money anyway, right?
Well, I think it's really comes back to the matter of communication and getting to know these people. I think that there's a lot of syndicators that believe that, with this advertising for investors, that they're going to be able to send a postcard and someone's going to send them a check for $100,000.
Which won't happen.
Yeah, no. So, you're still back to relationships and the reputation and being a member of your community, getting to know the people that are going to invest with you. And not only should you be getting, if you're the person putting the deals together, you've got to know the investor well enough to know that they're going to be compatible with you and that they're not going to create a problem for you somewhere down the road. But the investor also needs to understand and have a comfort level with the syndicator. But one of the things that we always write into our offering documents, with very limited exceptions, is an opportunity to remove the manager. So if they're not doing a good enough job, we'll usually say that 75% of the investors' interest can vote them out and bring in somebody else.
The deal there is like homeowners associations, though. You got to get enough investors paying attention. You got to go and organize those investors. Oh, that's difficult. Yeah, but
yeah. I used to do homeowner association litigation.
Yeah, that's a mess. Yeah, we both know what that's all like. You more than I, but I've seen it from the outside. Yeah, very, very good. But definitely some parts in, and I tell you, if I saw a deal where they're in Delaware and they want to contract away their fiduciary liability, I would be, I don't know, I don't think I'd be too interested in investing in that deal. But as we discussed, but yeah, really good stuff. I mean, your firm, this is what you do, and you're obviously an expert. Give out your website if you would.
Sure. Thanks a lot. Our website is syndicationlawyers.com, syndicationlawyers.com. And I can be reached at kim@syndicationlawyers.com.
Fantastic. Well, Kim, this has been just fascinating. Is there anything else you'd like us to know before we wrap up?
There's just one little thing I'd like to point out about crowdfunding. And there is a lot of confusion in the market about crowdfunding and what's legal and what's not legal. The Jobs Act authorized the SEC to develop regulations that would allow people to engage in crowdfunding in a way that investors could invest and expect a return on their investment. There is currently some crowdfunding that is legal pertaining to investors who invest in something not expecting a profit, but more like a donation.
Like Kickstarter or Indiegogo.
Like Kickstarter. Those things are legal. But until the SEC actually develops and publishes the final rules and regulations on crowdfunding for profit, it's not legal. And if you go to the SEC's website today, you can punch in crowdfunding and you'll get to their frequently asked questions, and you'll come to a point where it says, we'd like to remind people that crowdfunding for profit is currently unlawful. So there's a lot of companies out there that purport to be doing it. And, they're just jumping the gun a little bit. Everybody's really excited about it, and it's going to be a big deal when it actually happens. The anticipated time frame for that to happen and become legal is somewhere in 2014. So if you're thinking about doing crowdfunding, just hang on a little bit longer and, don't get too excited about it because we don't want to see anybody get in trouble.
Well, that actually leads to a really good question. I mean, what is the difference between crowdfunding, in quotes, and advertising to accredited investors? Crowdfunding is probably just a much smaller and more investors and non-accredited, non-sophisticated.
Yes. Yeah, I think that is truly the difference. And there's, some wrinkles that have to be ironed out between the federal and the state laws, whether, under Rule 506, remember, the federal law specifically preempts the state laws rules on advertising. Some of these other federal rules, they don't do that. So if you did a Rule 504 or Rule 505 offering or something under these proposed crowdfunding rules, it wouldn't necessarily preempt those state laws, so that you might also have to look at your individual state and see if it's going to allow you to do that kind of advertising. And if it doesn't, you still may not be able to do it. So there's a lot of stuff that has to be worked out. And we just see a lot of people out there that are kind of jumping the gun, and we're fearful that some of those people are going to end up in trouble, and we just don't like to see that.
Yeah, very good points, very good points. Well, Kim Lisa Taylor, thank you so much for joining us today. The website is syndicationlawyers.com, and what a great wealth of information. Again, thank you, and happy syndicating.
All right. Thanks, Jason.
This show is produced by the Hartman Media Company, all rights reserved. For distribution or publication rights and media interviews, please visit www.hartman.com. hartmanmedia.com or email media@hartmanmedia.com. Nothing on this show should be considered specific personal or professional advice. Please consult an appropriate tax, legal, real estate, or business professional for individualized advice. Opinions of guests are their own, and the host is acting on behalf of Platinum Properties Investor Network, Inc. exclusively.